Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Cut to the Chase. Now it's the July 4th Independence Day long weekend in the US. As was usually the case before the pandemic, and indeed like many other parts of the world, many Americans are using the opportunity to travel with a vengeance during this holiday period. The US Transport and Security Administration said airport screenings were back to pre-pandemic levels, and the American Automobile Association said a record 42 million Americans also plan to travel by road. No surprise that news headlines were filled with reports of delayed or cancelled flights as the airline industry struggled to cope. One news report noted that today's US airline industry is working with about 15% less staff compared with the pre-pandemic period. Now, while hopefully many of you also get to use the summer to travel, financial markets, fortunately or unfortunately, don't stop for a summer break. This may be a holiday-shortened week, but there are actually several key US data releases and events that could prove pivotal for markets in the near term. So first, in the US, we'll be keeping a close eye on the June jobs report. Consensus is looking for the headline jobs creation pace to slow to about 250,000 jobs and are looking for an unchanged unemployment rate. But the ideal outcome for markets may be one that is neither too hot nor too cold. A jobs report that is too weak could raise recessionary fears, but a report that is too strong could raise different fears of the Fed pressing harder on the brakes in response. Last week's weak employment component in the ISM manufacturing report suggests risks do sit to the downside. The Fed, of course, is also set to release the minutes of its last meeting. Now, Chair Powell's fairly detailed comments at the ECB forum last week should leave little room for surprise, but markets will scrutinize the minutes carefully for any signs of deviation. Now, the second thing you'll be watching, of course, in Asia Pacific, the key event being the Australia's RBA policy meeting. RBA Governor Lowe had earlier ruled out following the Fed with a 75 basis point rate hike, given the lack of new inflation data, though the Melbourne Institute's inflation expectations did continue to rise further, pushing consensus towards a 50 basis point rate hike. This, together with continued inflation pressures, we believe are likely to be supportive for the Aussie dollar, which is of course consistent with our own short and long-term views on the currency. Now, China, of course, does release service PMI data this week as well. Expectations are for the headline number to stay below the 50 mark, separating expansion from contraction, with services, of course, being particularly sensitive to COVID lockdowns. However, such an outcome in our view is unlikely to dent sentiment significantly, given the upside surprise in manufacturing sentiment numbers last week, which ended up printing above the 50 mark. For Chinese assets, the focus is likely to remain forward-looking on any positive policy measures, which we believe can help extend equity markets' recent outperformance relative to the region and global equity markets. Finally, from a market point of view, the S&P 500, of course, failed to hold above the 13,900 resistance level, maintaining a relatively weak outlook despite the strong rebound on Friday. The key focus for us, though, is the bond market. The 10-year government bond yield is now down about 25 basis points over the past week, and sets look to fall further, given net market positioning still remains short, or in other words, supportive for lower prices, and the fact that the yield did close below the 50-day moving average. Now, this supports our view to add bonds at the expense of equities. While the news headlines are likely to continue talking about how terrible the first half of 2022 has been for investors, given the correlated fall across both equity and bond markets, recall that our own look back at history shows that it would be extremely unlikely for equities and bonds to both continue delivering negative returns for the full year. We would instead be looking to take advantage of today's yields to add to bonds, particularly if growth concerns continue to escalate. So 3 ideas for a short week. One, of course, a potential short-term opportunity in the Aussie dollar. We, of course, maintain a preference for Chinese equities, but longer term, we think it makes sense to continue to add to bonds at the expense of equities. We'll pause there. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening and wish you a happy trading week ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.